Hello everyone, I'm delighted to welcome you to this Brainfood Bytes session. My name is Manish Rathi, and today I want to talk about a topic that will change the landscape of financial reporting disclosure for public business entities, the new DIE standard or disaggregation of income statement expenses. Let's start with a bit of context. For decades, the way we presented expenses in financial statement have largely remained unchanged. Most companies report expenses by functional categories like cost of goods sold or research and development cost. While this approach has served us well, it often leaves investors, analysts, and even management with unanswered questions. What's really driving these costs? How do labor, material, or other natural expenses flow through those functional buckets? And how can we compare one company's cost structure with another when there is so much hidden beneath the surface? Well, that's where DICE comes in. Financial Accounting Standards Board or FASB has responded to years of feedback from investors and other stakeholders who want more transparency and comparability in the financial reporting. With the issuance of ASC 220-40, public business entities will now be required to break down those broad functional expenses and disclose in the footnotes the natural expense category that make up these totals. This is a significant shift, and it's designed to help users of financial statement better understand company's performance, assess future cash flows, and make more informed decisions. So what exactly is changing? Under DICE, companies will need to provide a new tabular disclosure in their financial statement footnotes. For each relevant captions, think of cost of goods sold, SG&A, R&D. You'll need to show the amount of purchase of inventory, employee compensation, depreciation, intangible asset amortization, impairment losses, exit cost, warranty expenses, and for some industries, depletion, depreciation, or amortization related to oil and gas or mining assets. This means for the first time, investors will be able to see, for example, how much of your SG&A is driven by employee compensation versus depreciation or other costs. It's a level of detail that simply hasn't been made available before. But DICE doesn't stop there. The standard also requires you to disclose your total selling expenses and provide a clear definition of what selling expenses means for your company. This is important because there is no single universally acceptable definition of what selling expenses is, so management must exercise judgment in determining which cost to classify as selling expense, such as advertising, marketing, promotion, or distribution. And if your organization is involved in cost sharing or other expense reimbursement arrangement, you'll need to show those amounts separately or net them against the relevant captions with a clear explanation. Okay, now let's pause for a moment and consider a practical example. Imagine you're a controller of a mid-sized manufacturing company. Under the old rules, your cost of goods sold might have included a mix of raw material, labor, overhead, all lumped together under the standard cost methodology. With DICE, you'll need to now break how much of these costs are attributable to purchase of inventory, how much of this is employee compensation, how much of this is warranty cost, depreciation, amortization. This might require ERP system changes. A new data collection process needs to be established. It needs a close collaboration with your operations team. You'll also need to think on how to handle expense reimbursement, such as cost sharing with your suppliers or partners. And you'll also need to define what counts as selling expense for your business. Compare that against what's happening with your peer companies, document that policy, and apply it consistently. One important technical choice in DICE is whether to apply cost incurred basis or expense incurred basis for the caption that includes inventory cost. Cost incurred means disclosing cost when they are incurred and added to inventory, while expense incurred means reporting cost when inventory is sold. Both methods are acceptable. Whichever you choose must be applied consistently. We expect that many entities will elect to use cost incurred basis due to data collection challenges associated with expense incurred category. This decision will affect on how you explain your result to your stakeholders. Okay, now let's talk about timing. The DICE standard is effective for annual period beginning after December 15, 2026. Early adoption is allowed, and companies can choose to apply standard prospectively or retrospectively. Even though this might sound far off, the reality is implementing DICE is a journey that requires careful planning and coordination. The earlier you start, the better position you will be to meet the requirement and avoid any last-minute surprises. So how should you go about approaching implementation? The first step is to diagnose where you stand today. You'll need to identify which expense captions and natural expense categories apply to your business. This isn't always as straightforward as it sounds. For example, if you're a manufacturing company, you'll have complex cost structure that span across multiple business units or geographies. If you are in a tech company or a service-oriented company, you might need to think carefully on how to allocate cost between what's happening on the function side or the natural expense category. Once you mapped out your expense landscape, take a close look at your current systems and processes. Can they capture the data that you need for these new disclosures? Are there any gaps that needs to be addressed? A thorough gap analysis will help you see where changes are necessary. Another key consideration is stakeholder communication. Dice disclosure will likely raise questions from investors, analysts, and auditors who are now seeing expense details for the first time. Preparing a clear, concise explanation about your methodology, key drivers behind expense category, and any significant fluctuations will be critical in building and avoiding any misinterpretation. Of course, DICE isn't just a compliance project. It's a change management exercise. You'll need to ask yourself some key questions. Can your system accurately capture and report the required expense category? Do you have the right resources and budget? How will you communicate these changes internally and externally? There are some key technical questions to consider as well. What will be your transition, whether it will be prospective or retrospective? How will you define what is considered a selling expense? How will you apply practical expedient, whether you're going to use cost incurred or expense incurred method, and overall, are you ready for expanded disclosure both in your interim and annual financial statement? As you prepare for DICE, my advice is to start early. The sooner you begin your diagnostic, the smoother your implementation will be. Build a cross-functional team comprising of accounting, finance, IT, procurement, and investor relation. Make sure everybody understands their role. Document your policies and procedure to align with requirement. Invest in training and keep an eye on what peer companies are doing. Let's not forget the benefits. While DICE will require effort and investment, it also offers an opportunity to improve your internal reporting, enhance your understanding of cost drivers, provide greater value to your stakeholders. Overall, this change aligns with broader trend in financial reporting towards transparency and enhanced investor communication. To summarize, DICE represents a major shift in financial reporting disclosure, and it is also an opportunity. By embracing these changes, you'll not only meet the new requirement, you'll provide greater transparency and value to your stakeholder and help organization tell a clearer, more compelling financial story. Thank you for joining me in this Brainfood Bytes session. If you have any questions to discuss on DICE implementation in more detail, please reach out. Thank you for listening. Thank you. Bye.